So the Fed did come out today and they stated that they're going to raise rates another 25 basis points, which now moves the federal funds rate between 4.75 to 5%. Powell did mention that their baseline expectation is they're not doing any rate cuts this year and that they're going to continue to keep tightening until they see that inflation has somewhat came down to their target, which is about 2.5%. Welcome back, everyone, to another episode of Insightful Principles. Today, I want to talk about the Fed's decision when it came to interest rate hikes and what their approach is going to be for monetary policy moving forward. It definitely shook the market up a little bit at the beginning of his conversation when he had his speech in front of a lot of the reporters today. The market was up, but then by the end of it, the market was down. So I'm going to talk about some of those different elements of what happened today. What was some of the important language throughout the Fed meeting today, and what the expectations seem to be when it comes to interest rates moving forward. But as always, if you all can please do me a huge favor, please like, subscribe, and share. It definitely helps out tremendously, and it doesn't cost a thing to do that. Also, don't forget to hit that notification bell below so you can be notified every week when I drop insightful content. So the Fed did come out today and they stated that they're going to raise rates another 25 basis points, which now moves the federal funds rate between 4.75 to 5%. And the probability that the Fed was actually going to raise rates today was actually about 86%, according to the Fed Watch tool by the CME Group. And they also had a probability of it being a pause was about 14%. So that just goes to show that a lot of the probabilities actually show that the Fed was actually going to raise rates today. And definitely the market was down. The S&P 500 was down 65 points today. And it's now below that $4,000 level that a lot of people have been watching. The NASDAQ was down 190 points and the Dow was down 530 points. There were some bright spots. As we've noticed, commodities have been doing very well in this environment, with this inflationary environment, with the issues we're seeing with a lot of the bank failures and seeing just expansions of the Federal Reserve's balance sheets in certain parts. The commodity markets like gold, they've been doing exceptionally well. Gold was actually up 32 points today. Was around the price of gold right now is around 1973. Silver also had a good day. Was up about just below 1%. But silver is somewhere around $23 right now. So definitely was some bright spots, but a lot of the major indexes were down. Is the Fed going to potentially pause? Are they going to slow down rates? Looking forward into the next meeting in May. And actually the probability as of now, it's about 50-something% that they expect that there's going to be a pause with interest rate hikes, and then there's about a 42% probability that they're going to raise another 25 basis points. Now, throughout the conversation, Powell did mention that their baseline expectation is they're not doing any rate cuts this year, and that they're going to continue to keep tightening until they see that inflation has somewhat came down to their target, which is about 2.5%. Inflation, especially core inflation, is about 5.5%. So the federal funds rate is getting very close to being above that. So that's why a lot of people are expecting that we are getting to a point where there's potentially going to be a pivot if the inflation data shows that it's going down. Powell did mention that if they see more data showing that a possible pause, they will consider it. But as of now, they're going to continue to keep tightening. So I thought that that was very interesting. And I think that, another indicator that you can look at is you can look at the 2-year Treasury note. And this really just shows forward policy expectations. And today it was trading, in a lot of different, places. Before the meeting, the 2-year Treasury was at 4.1%. Now it's at 3.9%. So a lot of people are looking at that as a possible indicator that they are nearing being able to be done with raising interest rates, because we are seeing that the 2-year treasury is showing us that 3.9% is more of the forward policy expectation, but we're at about 5% right now. So I know throughout the meeting, he also talked about that for 2024, they think that the federal funds rate is going to go to 4.3%. 2025, they expect that the federal funds rate is going to get to 3.6, and they think that over the long term, they should be able to get it as low as 2.5%. Now, when I mentioned the federal funds rate, all that simply is the interest rate that banks and other depository institutions would charge each other whenever they're lending money. So a lot of the questions today that was being asked to Powell is, how is these further interest rate hikes going to create more tighter credit issues within the market? We've seen the bank failures with Silicon Valley Bank, Signature Bank. Is that going to cause them to actually pause even faster? Because the interest rates that they're increasing, the more they higher interest rates, the more tighter that credit becomes, the cost of debt becomes much more expensive. But Powell did mention that inflation is their biggest concern right now, and that they have more than enough tools to be able to address the liquidity issues within the banking industry. They did state that the issues that we've seen with SVB and Signature Bank does not show that there will be broader issues within the banking system. They think that they do have everything under control, and it'll yet be determined to see what happens. We'll see if there will be future bank failures, if this will create more liquidity issues for other banks. Only time will tell. So I think, more data has to come out, and we're going to see what happens. But, I think it was important for him to exuberate that confidence, to say that they do have everything under control, because if they would have paused interest rates in today's meeting, it really would have showed that there's deeper concerns, that they feel that they don't have enough tools to be able to address some of the banking issues that's happening right now. And I know Powell did mention that they are doing a deep review on the bank run that happened with Silicon Valley Bank, and they're doing more of an investigation to figure out what went wrong. And they do expect that there's going to be tighter regulations. They do think there needs to be tighter regulations and more supervision to help prevent any type of future bank collapses or failures within the future. I think paying attention to that federal funds rate, looking at the 2-year treasury yield, gives you an idea of what forward policy expectations are to be expected, what's being priced in. I think the data that still needs to be determined to give the Fed more clarity on pausing rate hikes is, like I mentioned, core inflation. That's right now 5.5%, and the actual inflation numbers year over year is 6%. So I think as that federal funds rate starts to go above the inflation rate and also core inflation, that's when you'll start to hear more talks of a pivot or a pause. I thank you all so much for watching this video. Please like, subscribe, and share. Don't forget to hit that notification bell below so you can be notified every week when I drop content. And I thank you all so much for watching another episode, and take care.